two men, same bank, same loan, same amount. One of them used that money to build quiet wealth that still grows while he sleeps. The other lost everything: his savings, his house, his plan. The difference had nothing to do with luck, nothing to do with income. It had everything to do with understanding how financial institutions actually work. This is their story, and by the end of it, you will know exactly which side of that line you are standing on. The first man, call him Raymond, walked into a bank on a Tuesday morning in his early 30s. He needed capital. He had an idea, a modest track record, and a handshake confidence that had served him well in smaller rooms. The loan officer was professional, efficient, and friendly. Raymond signed the papers in under an hour. $43,000 deposited by Thursday. He used it the way most people use borrowed money. He covered gaps, he smoothed out cash flow, he bought equipment he needed immediately, and furniture he needed eventually. He felt, for the first time in years, like he had room to breathe. The monthly repayment was manageable. The interest rate felt reasonable. He did not ask what the bank was earning on the arrangement. It did not occur to him to ask. The second man, call him Conrad, walked into the same bank 3 weeks later. Same branch, same type of loan, same $43,000. He signed the same papers. He also did not ask what the bank was earning. But he spent the next 4 days reading everything he could find about how the money he had just borrowed would be used by the institution that lent it to him. What Conrad learned in those 4 days changed the entire shape of his financial life. Here is what most people never find out about financial institutions. A bank does not simply hold money, it moves money. When you deposit funds, the bank lends most of it to other borrowers at a higher rate than it pays you. When you take a loan, the bank earns interest on capital it did not produce through labor, it produced it through a mechanism called fractional reserve banking. The spread between what it pays depositors and what it charges borrowers is its engine. That engine runs continuously, whether markets rise or fall, whether you are sleeping or working, whether you understand it or not. Insurance companies collect premiums and invest the float, the money held between when a policy is paid and when a claim is made. Investment banks facilitate transactions and earn fees on every movement of capital. Pension funds manage long-term assets and charge management fees that compound against your returns over decades. None of this is hidden. None of it is illegal. It is simply the way financial institutions are designed to function. They are machines built to generate returns. The question is not whether they generate returns. The question is, for whom? Raymond did not ask that question. Conrad did. Raymond spent the next 3 years making his monthly repayments. The business grew modestly. He reinvested what he could. He kept his loan in good standing. By the time he paid it off, he had returned $43,000 plus $11,000 in interest. The bank had earned $11,000 from Raymond's labor, his stress, and his discipline without participating in any of it directly. Raymond did not feel cheated. He felt relieved. He had paid it off. He moved on. Conrad took a different path with the same loan. He used the capital to acquire a small income-producing asset, a storage facility with 38 units in a modest industrial area, priced below market because the previous owner had kept inconsistent records and scared away buyers who wanted clean paperwork. Conrad spent 6 weeks cleaning the records. The asset began generating $1,800 per month net within 60 days. He took that income and opened a high-yield savings account at a credit union, a type of financial institution owned by its members, meaning the returns flow back to depositors rather than to shareholders. The rate was modest, but it was compounding in his direction rather than against him. He also opened a brokerage account and began purchasing index funds, passive vehicles that track broad market performance, charge minimal fees, and require no active management. He was not trying to beat the market. He was trying to join it quietly, consistently, without paying intermediaries more than necessary. Within 4 years, Conrad's original $43,000 loan had been repaid in full, but unlike Raymond, Conrad had not simply returned to zero. The asset he acquired with that loan was still generating income. The savings account was growing, the index funds were compounding. He had used a financial institution's money to build a system that generated money, and then he had redirected that money into financial instruments that worked for him rather than for the institution. He was not wealthy by most visible measures. He still drove a practical car. His apartment was the same one he had rented for 6 years. But his net position was moving steadily in a direction that Raymond's was not. Stop here, because this is the moment most people miss. Raymond and Conrad did not make different decisions because one was smarter. They made different decisions because one understood what financial institutions are actually designed to do and used that understanding as a map. A bank is not your partner. It is not your enemy. It is a machine with a function. That function is to generate returns on capital. If you understand the machine, you can position yourself to benefit from it rather than simply fuel it. The most important question you can ask about any financial institution is not what it offers you. It is what it earns from you. The answer to that question determines which side of the transaction you are standing on. Raymond earned enough to repay his debt. Conrad earned enough to build his next asset. Both used the same institution. Both paid the same rate. The difference was not the institution, it was the intention behind the transaction. Here is what that looks like in practice. When you deposit money in a standard savings account earning less than inflation, the bank lends it out at a significantly higher rate. The spread is the bank's profit. You are the source of that profit. When you move that same money into a high-yield account, a credit union, or a short-term treasury instrument, you capture more of the return that your capital generates. You are not avoiding the financial system. You are navigating it differently. When you take a loan to fund consumption to cover gaps, smooth cash flow, buy things that do not generate income, you pay interest on a depreciating arrangement. When you take a loan to acquire an income-producing asset, the asset services the debt and potentially generates surplus. The loan is the same instrument. The outcome depends entirely on what it purchases. When you buy insurance without understanding the policy structure, you may be funding a float that earns significantly more than your premium in returns the insurer keeps. When you understand the structure, you can select coverage that is appropriately priced for your actual risk, rather than for the insurer's maximum margin. Financial institutions are not traps, they are tools. Used without understanding, they transfer wealth from you to the institution. Used with understanding, they can be directed to transfer returns toward you. Conrad understood this. Raymond did not. Not because Raymond was careless, he was careful, disciplined, and hardworking, but because no one ever explained to him that the same tool, used differently, produces an entirely different outcome. Raymond is still working. His business is stable. He has a savings account and a modest pension. He is not struggling, but he is also not ahead. He is running to stay in place. Conrad stopped working for the same income he had at 32. He still works, but differently. He manages systems rather than tasks. He reviews statements rather than timesheets. The financial institutions he once simply borrowed from are now part of a structure that generates income on his behalf. The gap between them was not created by a dramatic decision. It was created by one question, asked early, that Raymond never thought to ask. What is this institution earning from me? And is there a way to flip that arrangement? Most people walk into banks, sign loan documents, open savings accounts, and purchase insurance policies without ever asking that question. They are not naive. They are simply operating without the map. You now have the map. The financial institutions have not changed. The mechanics have not changed. What changes, the only thing that has ever changed any of this for anyone, is the understanding you bring to the transaction. Raymond and Conrad sat in the same chair, signed the same papers, left the same building. One of them left with a debt, the other left with a plan. The chair is still there. The question is what you will do when you sit in it.